currency is valued in terms of its exchange rate, which is how much one currency is valued in terms of another. Currencies' values are determined by the supply and demand in foreign exchange markets. For example, this diagram represents the market for pounds sterling, which are valued at $1.35. Changes in how much a currency is bought impacts its demand in foreign exchange markets. If the UK starts exporting less to the US, perhaps due to the imposition of tariff barriers, there will be less demand for pounds sterling, causing demand for the pound to shift left, which causes it to depreciate in value. This could also happen if speculators decide to buy less UK assets, like stocks, real estate, etc., which are denominated in pounds. This is because less pounds are being demanded, as less assets that are priced in pounds are being bought. When a currency is sold, it is released, in a sense, into foreign exchange markets. If pounds are used to buy dollars, there'll be more pounds available to be bought by others in the market. Imagine a fruit market, where you buy fruit with other fruit. If you bring apples to the market to buy oranges, demand for oranges will increase, causing its price to rise. Also, the price of apples will fall, as there's more apples available on the market because you brought them there. Changes in how much a currency is sold influences its supply in foreign exchange markets. If Britain started importing more, then supply of the pound would increase and cause a depreciation of the pound as more pounds are being made available in foreign exchange markets. Similarly, if capital flight were to take place in Britain, meaning investors start selling off UK assets, the supply of pounds would increase, which would also cause depreciation. So, changes in trade patterns can influence exchange rates. Also, changes in the value of currencies can influence trade. If a country's currency appreciates, that will make exports from that country more expensive abroad, and imports cheaper there, which means that country will export less and import more. Likewise, if that country's currency decreased in value, that would make the country's exports cheaper abroad, and imports more expensive at home. So, the value of exports would rise and the value of imports would fall. Since the Second World War, the rise of trade blocs, the dismantling of protectionist barriers, and improvements in transportation and communication technologies have all led to a large increase in global trade, which includes the flow of inputs and intermediate goods, meaning production processes have become global through trade. This means trade flows have allowed countries to become more specialized, as they can focus on producing what they're best at and trading with other countries for everything else they need. The balance of payments tracks the movement of funds across a country's borders. It is made up of the current account, the capital account, and the financial account. It balances when the current account is equal to the capital account plus the financial account. The capital account tracks non-productive transfers between countries, which are transfers that do not result in economic output. For example, if the USA builds an embassy in Japan, the Japanese government might sell land to the US government, which would be recorded as a credit to the Japanese capital account and a debit to the American one. However, the capital account is small and therefore negligible. The current account is made up of trade in goods, physical objects like shoes or pencils, trade in services, which would be financial, insurance, educational, law services, etc., investment income like rents or profits made on assets, which can flow into a country from abroad and be recorded as credits to the current account, and investment income can also flow out of the country, as foreign investors may own domestic assets, which would be recorded as debits here. The last part of the current account is current transfers, which are cross-border transactions performed by individuals and entities, such as remittances, which are when foreign workers send money back to their home country. Remittances are an important source of income for many countries that have large migrant populations. The financial account tracks financial flows in and out of a country. It is composed of foreign direct investment, which are long-term investments. For example, if a Japanese firm builds a factory in Vietnam, that would count as foreign direct investment. Portfolio investments are short-term and can be reversed more easily. Buying shares in a foreign company would fall under portfolio investment, as this kind of investment is more short-term than something like investing in a factory. Reserve assets can be a little counterintuitive. Central banks hold reserves of foreign currencies for many reasons. For example, reserves can be used to manipulate the value of the domestic currency. What's counterintuitive is that holding reserves acts as a debit on a country's financial account, and having one's currency held in another central bank acts as a credit to that country's financial account. If you sell me something, and I convince you to hold on to my country's money in exchange, we've made a transaction, and both sides must equal each other. The current account must be balanced out by the financial account. China has a surplus on its current account, as it exports much more than it imports. This means funds are flowing into China. If these funds don't flow out again, China's currency, the renminbi, would appreciate until the current account surplus disappeared. This doesn't happen because these foreign funds that flow into China are reinvested abroad, which is why the Chinese financial account is in deficit. On the flip side, the USA has a current account deficit as it imports more than it exports. This means the US consumes more than it produces. It's able to have a persistent current account deficit because it has a positive financial account surplus that funds it. America's trade deficit is financed with foreign funds flowing into the USA to buy up American real estate, shares in American companies, and other American assets. The huge increases in global trade that have taken place over recent history, which includes the trade of inputs and intermediate goods, has resulted in lower prices and more variety for consumers all over the world. This is because if there's more trade, the cheapest factors of production can be accessed by firms. If states impose laws that restrict production to certain geographical areas, then production processes will be made less efficient as firms cannot access the cheapest labor, land, and capital if they aren't able to move inputs and finished goods across borders. So, global trade has contributed to deflationary pressure while also increasing real output as it provides many supply-side benefits. Globalization and international trade have benefited consumers, generally, through lower prices. But, while the benefits to consumers are dispersed, some groups have been acutely hurt. Many areas in the USA or Europe that used to focus on manufacturing have seen high levels of structural unemployment, where the skills that are available in these areas do not match what employers are looking for. Back when American demand for cars was almost totally satisfied with American supply, Detroit was the second largest city in the U.S. in terms of population. Once that was no longer the case, high levels of structural unemployment began to erode the city's population and its tax base, as manufacturing jobs started being performed by people in Asia and Latin America. Long global supply chains can be very efficient, assuming everything is working as it should. iPhones would be much more expensive if the production of all the components, as well as the final assembly of the product, were done all in the same location, as opposed to having all the different steps of the production process performed by the cheapest labor possible. Designing the phone in the US, making the screen in Germany, the battery and other components in Taiwan and South Korea is all well and good when conditions are normal and expectations are stable. That isn't always the case, however, as the COVID pandemic showed us. When there is a disturbance, having all the parts of the production process close together suddenly becomes more appealing.